I know, like, what the hell? Either 20 minutes.
Welcome to our UCLA Extension Department of Business, Management, and Legal Programs video lecture series on new entrepreneurship, new venture formation, and strategic business plan development. This video is an introduction to how to develop your financial statements. It's basically business, accounting, and bookkeeping 101. I'm Harry Redinger, your instructor. There is a total of over 40 videos in this lecture series that integrate with our UCLA Extension online course management program, Canvas. Each video strives to be brief, but will have a bit of overlap to tie our curriculum together. Okay, let's get started. We're at a point in our curriculum where we're 100% transferring out of the whole theory, concept, structure into just pure numbers. Understanding our business by the numbers is essential. And so, business plans, the whole entrepreneurial venture type quest journey starts off with a mission statement and a business person saying, aha, I see a need. And this whole process distills down to eventually a cash flow projection to where there's a number at the bottom right-hand corner after 5 years of work that symbolizes the annual income that the company, a profit that the company generated. And that's the end result of all this planning process. But the numbers are something that we just instinctively, inherently have to know. I'm going to sound a little silly here, but based on the weather, we should know how that's going to affect our profit margin today or this week. There's a successful entrepreneur has a feeling and understanding of how the business is going to respond based on the conditions and what's going on in the marketplace. And it takes a lot of experience and a lot of work to get to the point where you truly can understand your business by the numbers. God's sakes, I think 70% of people starting a business know nothing about financial management. They don't even know what the accounting equation is. And it's the structure, it's the formula that sets up all transaction. Everything but everything integrates into the accounting equation. So if we don't know what the accounting equation is, we're just not going to understand any of this information whatsoever. And so the objective of this lecture is the introduction to the accounting equation and how the accounting equation is used to set up the income statement and the balance sheet and the income statement, and then from there how we generate a cash flow analysis. So in order to be able to develop a cash flow projection, which is absolutely an essential understanding and skill that an entrepreneur has to have, even if you have nothing to do with bookkeeping and accounting, but in your mind you have to understand the structure of the accounting equation and how that distills into the balance sheet and the income statement, and how the income statement is a cash flow projection is a projection of income statements. We also have to understand a little bit about depreciation and the accounting cycle, how to open and close the books on an annual basis or fiscal year basis. So before you right now, we have the accounting equation, and the accounting equation basically, and I'm just going to go over this real quickly. Assets, okay, that's value. Whether you own it or not, it's value that the business, you own it. It's an asset of the business. Minus liabilities, the money that you owe credit cards, the money that you owe banks, equals equity. So equity is what you actually own. So the worth of the company value, the book value of the company minus liabilities, the money we owe, equals equity, what we actually own in the business. and then what we own in the business plus, okay, what we've earned to date in the business. We call this our income statement. So, and that's calculated by revenue, the money we deposit in the bank, minus the direct cost of sales, checks that we write to vendors to produce and payroll, to produce our goods and services, minus our company overhead. So the revenue profit to date. So the accounting equation says the value of the company minus what we owe equals our equity in the company plus the profit we've made to date, which is revenue, bank deposits, minus direct cost of sales, minus overhead. That's the accounting equation. And everything but everything feeds into it. It is the structure of all financial transactions in business. To unlock the accounting equation, we have to have enough knowledge, and that's why I have a key here, and that's the whole purpose, really, the fundamental objective of this talk, is to empower you with enough knowledge to be a key that you can stick into Quicken QuickBooks and know what's going on. Because Quicken QuickBooks, which 90% of, I would say, all businesses work with in some kind of way, and 90% therefore of all CPA firms work with it, as a standard vehicle of, it's like the Amazon of accounting. It's the 800-pound gorilla in the accounting industry. And so all CPAs have it and know how to work with it, and coming up to speed with it, have enough minimum knowledge to get information in it so that you can transfer these files to a CPA or a bookkeeper or on a quarterly, annual basis to generate your financial statements for tax returns and things like that is absolutely essential. The reason why we have this slide up here is programmed into Quicken QuickBooks is the accounting equation. But if you don't understand what the accounting equation is doing, you're not going to understand any of the reports that kick out of it. You won't understand how to read it, nor will you understand how to adequately enough enter data into Quicken QuickBooks, because you might not understand what's an expense or what's an asset. Okay, so are you? And we'll talk more about that. But when you write checks to vendors, are you buying an asset? Are you putting money to an asset and buying something which still basically has value, which means you're going to be taxed on it, or are you writing check to leasing or renting equipment? So we have to kind of understand, what's an asset, what is direct cost of sales, what's overhead, and how does that all fit into the accounting equation, and how. So our objective is to empower you with enough knowledge to be a key to stick into Quicken QuickBooks to start using it as a tool. This particular slide here is very key to understanding the accounting equation and how it applies to all the fundamental basic knowledge you'll need as an entrepreneur. That's it. If you can understand this, you understand the key to stick into Quicken QuickBooks. So we're going to step through, the information on this slide and how to understand it. So first off, in the middle, we have the accounting equation. And again, as we shared earlier, there's assets minus liabilities equals equity. This is what we actually own. Plus revenue minus direct cost of sales, things we write checks to for, to produce the goods and services that we are selling, minus indirect cost of sales or overhead. So there's the accounting equation, and then to the right of that, we have the general ledger chart of accounts. And the general ledger chart of accounts says assets will always have a 1 or 100 or 1,000 number. Liabilities has a 2 or 2,000 or a 2 number. Equity, a 3. Revenue, 4, 400, 4,000. 4 dash, or there's always a 4 in front, and then direct cost of sales, a 500 account, or 5,000, 5 dash something, and then 6 is our overhead or indirect cost of sales. that is, what you're looking at is universal. Every country in the world works with that system. Every state in the United States, every business, every CPA uses that number system to define your general ledger chart of accounts. Now, just a little sidebar note, for individuals, not corporations, for individuals who have personal income or a day job, sometimes there is a 700 and 800 account. So the 700 and 800 accounts, which are not shown up there, are additional income and additional expenses. And what they represent are private or non-business. In other words, you're filing as an entrepreneur, owner of your business, you're going to file an income tax return. And so that you can include other income, such as your day job, other expenses, such as things that you can deduct that are in your residence, such as what percent of your home is dedicated to office space, then mortgage payments or rent payments and things like that can be deducted as business expenses. So we have their additional income and additional expenses. Now, it's not shown up there, but no, that's how we integrate into the account equation financial categories that are personal and non-business related, from the standpoint of using your QuickBooks for a personal tax return, which you are the business in that sense. I'm going to put up here now. Actually, I'm going to go back to the left of the accounting equation up there. We have the balance sheet, which represents assets minus liability equals equity. So that says, basically, bottom line is, what are we worth? What are we worth? No matter how big the organization is, there's going to be just three parts of information there. So if even it's a multi-billion-dollar organization, and a balance sheet's going to show that its assets, its liabilities, and what it's worth in terms of equity. And equity deals with investment. It deals with, and we're going to talk about it, part of equity is also an account called retained earnings, which is an interesting account because it's used to close the income statement out at the end of every fiscal year. So most people learning this for the first time, retained earnings is a very complex number because it gets bigger and bigger as long as you're making a profit, bigger and bigger every year. But does it represent money in the bank? Well, no. It just shows this is what you earned at the end of every fiscal year, year after year after year after year, and you can kind of use it to get a feel for the success of a business. But the real purpose of the retained earnings account is an account that's used to close out the income statement categories at the end of every fiscal year, and we'll talk about that in a second, relevant to the accounting cycle. And then below we have and we're going to go over all this again, but this is just a flyover of everything up here. And then in the lower left-hand corner, we have the income statement, which is which summarizes the income earned to date. Income earned to date. The date meaning this fiscal year, because at the beginning, the first day of every new fiscal year, all your income statement accounts go to zero. We do what's called reverse journal entries, or the computer does this automatically to zero out all the income statements. So the first day of the new fiscal year, all those accounts go to zero, and the balance of those accounts, positive and negative balances, go to the retained earnings account in equity. And then in the lower right-hand corner, we have a cash flow projection, which is a cash flow projection of income statements month by month by month, or quarter by quarter by quarter, but usually on a monthly basis, as we project the income going in the future. And there's a number of techniques we use for doing that. We're going to touch on those. Okay, we're going to now start drilling down on this. So everything that we're going to talk about is related to this particular diagram or PowerPoint sheet as we go forward. Here's some more just general information about the general ledger chart of accounts. Again, you can see the 100 asset accounts, the liability accounts, equity accounts, our income statement accounts, revenue, direct cost of sales, and overhead accounts. Know that to a floor plan to an architect gives can tell what the building is going to be used for. Is it residence, is it commercial? A general ledger chart of accounts is to a CPA the design, the business model. You can, if you look and understand what you're looking, you can probably figure out what the mission statement of the business, what it manufactures, what it does, what type of payroll, equipment, profit centers, and assets and things like that. You can pretty much figure out what kind of business by just looking at the general ledger chart of accounts. Just like looking at a floor plan, you can kind of see what kind of, is this a residential business, commercial, is it manufacturing, a restaurant or bus station? You get a feel for what kind of building it is. One of the most important things I want to point out about this particular slide up here is that note that for every revenue account, there is a direct cost of sales account. Now, not all CPAs and bookkeepers set the books up this way, but just a kind of a dumb logic understanding that our direct cost of sales our revenue accounts minus our direct cost of sales account is going to give us an idea of what our initial profit is. And then when we subtract out our overhead, that's our actual net profit that we've earned. So, but a good way to kind of understand so that we know whether we're making money or losing money per our revenue accounts, that for every revenue account, in theory, we want to have a direct cost of sales account. So for every 400 account, there's going to be a corresponding 500 series account. And if we take one, subtract from the other, we can tell what kind of profit we're making per our profit centers. And as you know, if you've been sticking with our lecture videos as we go through, our profit centers are market opportunity accounts, are the areas of the marketplace that we're trying to capitalize and develop profit centers at. Profit centers or market opportunities eventually become called revenue accounts. And then our overhead accounts are all the things that we cannot track directly back to a revenue account, such as office assistants or utilities, insurances, office lease, tenant improvement, things of that sort. In accounting, we often refer to as T accounts, and accounts in the accounting equation have what's called normal balances. So every account, the asset, liability, assets have a normal debit balance, liabilities a normal credit balance, equity a normal credit balance, revenue a normal credit balance, direct cost of sales a normal debit balance, overhead a normal debit balance. So in accounting, it's called a double entry system. So for every transaction, there's going to be a debit and credit in your accounting equation. So if you buy something, money's going to go out of cash and into an asset account, such as office furnishings or computers or into inventory. So every time you write a check, you're taking money out of your cash account and you're putting it in another account somewhere else. So we always refer to our accounting as a double entry system. Every time you do a transaction, it's going to trigger two entries in your general ledger chart of accounts. Something to always be aware of. But I want to introduce you, in case you've never seen it, the accounting, a book, QuickBooks in accounting uses, in theory, T accounts. Whether you don't even see this stuff going on inside QuickBooks, and depending on how you generate your reports. But every account is a T account with debits and credits and a normal balance. So now we're going to go back to this kind of master template here of our financial statements, and we've highlighted the balance sheet area, the first part of the account equation, asset minus liabilities equals equity, and so always know that this is the balance sheet aspects of the accounting equation, and the revenue minus direct cost of sales minus overhead, or what we have here is indirect costs, but we can also call it overhead, is our income statement aspects of the accounting equation. And as I've stated, the general ledger is directly related to the accounting equation. The accounting equation is the structure of our general ledger chart of accounts. So if we memorize our accounting equation, we also just memorize the sequence of the general ledger chart of accounts. There is a direct correlation between the two, how they fit together. Next is understanding that our income statement is revenue, and I'll only just have these three things in it: revenue minus direct cost of sales minus our overhead, and there's a blow up on it. There's our total revenue accounts, our total direct cost of sales. And then our expense accounts, our total expenses, then our net income, and then we have administrative expenses, but bottom line is it shows our net income, which is going to go up to our balance sheet. But anyway, income earned per the current fiscal year. The income statement is a statement of income earned this fiscal year. Most businesses have a calendar as a fiscal year in terms of January through December. But sometimes some organizations have fiscal years that start in June or July or a different month for a whole host of reasons, but there's a calendar year and there's a fiscal year. Most businesses, they're one and the same. But here's a blow up on our income statement in terms of showing revenue minus direct cost of sales minus our overhead. The next statement is now we're going to drill down and take a look at the balance sheet, and the balance sheet says what we're worth at any given time. These are running accounts; they do not get closed out at the end of the year. They're ongoing accounts until we go out of business. And so here we're going to have total assets, the total book value of our business. Now, if we don't buy assets, assets eventually go to zero. And so therefore the only thing left is cash. And so cash is an asset too. But in terms of physical plant assets, equipment, and things like that, they eventually depreciate to zero based on general accounting procedures and or IRS guidelines. So there's book value, but there's market value, and they're totally two different things. So when we're dealing with accounting and bookkeeping, we refer to the value of the business from a book value standpoint. And so our assets, which is the value of the business, minus our liabilities, which is any loans that we have, is going to equal the equity, what we actually own of the business. And so that's what it tells us. It basically says this is what we're worth at any given time when we take a look at a balance sheet and the date on that balance sheet. This slide here kind of helps you understand the relationship of the balance sheet and the income statement. So on the balance sheet, it says assets will always equal liabilities plus equity. So what we owe plus what we're worth is going to be the total value of our assets. So the amount that we owe and what we earn are going to equal assets. Okay, so that's always going to be a true statement. If we make two circles up here and a circle that represents the balance sheet, if we take the circle and divide it in two, our assets will always equal our equity plus our liabilities. Now, I note that equities and liability are like 25% and 25%. That's just, and that's why I have the arrows going either way. That's just just that is not necessarily always going to be the case. Liabilities, but it'll be some percent of that. If there's no liabilities, everything's equity, and then therefore assets will equal equity, given that we have no loans. Our income statement, by the same token, we can say revenue will always equal our direct cost of sales, our overhead, plus our profit. And so if we take and add profit plus direct cost of sales and overhead, those will always equal our total revenue. Money in the bank is going to equal the money that's left over in profits, overhead, and a direct cost of sales. That will always be a true statement. Now, the numbers for direct cost of sales, overhead, they can vary and vary greatly, but that's always going to be a true statement, that your revenue will equal direct cost of sales, overhead, and profit. And that might help you have a better understanding of the relationship of these accounts and how they relate to each other. Now we're getting into the world of how to do a cash flow projection, and you, the entrepreneur, you, the business owner, have to understand this, because as you make decisions on the fly throughout the day, the week, the month, the quarter, the calendar year, you have to have an understanding of, are these numbers going up and down, and our goal is to maximize profit and grow the business. So we have to understand a projection of our income statements on a monthly basis. And we also, and as we stated in other lectures and videos here, we want to see financial problems coming. We don't want to be surprised. We want to, if the economy looks like it's going down, or there's new tax laws, or something happens, a war, or all kinds of things can affect the economy. If we see technology changes and things of this sort, if we see something coming, we want to make a change way in advance, or be aware of it, so we're not caught off guard, caught by surprise. And if we go back when we did all the market analysis stuff and the industry analysis, we want to understand the cycles of the business, because there's times of year that the income for certain types of businesses will be up. Obviously, like Christmas trees in December and bicycles in June and July. Where it's in August, where it's summer, so people are out and about riding their bicycle, or buying snow skis and snowshoes in October, November, December, January, February kind of thing. So you kind of have to know the cycles of our business, because they're going to have a direct impact on our cash flow month by month by month throughout the fiscal year. As an entrepreneur, you just have to know that, and you have to know how to prepare for these peaks, as well as have money set aside for the valleys throughout the fiscal year. So our cash flow projection is a projection of our revenues, our direct cost of sales, and our overhead accounts. And this is where experience comes in, especially when we're outlining our overhead accounts. If you don't know, you just don't know. What are telephone costs? What are insurances? And insurance is a big thing for some industries. I mean, it's just like the construction industry. Certain types of trades, such as like if you're a roofing contractor, and if your men are working over 16 feet off the ground, the premiums, the workman's compensation premium is 100% equal to what you're paying. So every dollar you pay the employee, you're paying that exact same amount to a workman's compensation fund. I mean, it's just crazy expensive. So if you don't know these things and aren't taking this stuff into consideration, you've got a really nasty cash flow surprise coming at you. Some of these things are super duper expensive, and that's the law. That's just the way things are. Now, if you're a secretary inside an office, for every dollar that for every $100 that goes into a secretary, it might be only 50 cents that goes into workman's compensation. So there's big differences that you as the entrepreneur need to be aware of in terms of expenses that you are gonna be responsible for in your business. So going back, all financial transactions are based on the accounting equation, and so the So understanding this and a fundamental responsibility, skill, talent, insight is how to project your income statement into the future based on historical track record, as well as the cycles in the industry, and in addition to just personal knowledge and experience. I want to talk about depreciation for a little bit here. The IRS has what we call, and I'm going to go to my next slide here, the IRS has what's called generally accepted accounting principles. Generally accepted accounting principles. The IRS, per your SIC code, per the type business that you're in, has depreciation laws that affect your business. And here, the IRS will say that if you're like hand tools, things that can be used within a year, they can be immediately expensed. At the end of the year, they could go, they're 100%, they're what we call a small tools expense. So there's no need to depreciate it. When the second you buy it, it's like office supplies. It's an expense. But then if you buy a table saw or a piece of heavy machinery, well, then it might say you can depreciate 10% a year of over 10 years, or you can depreciate 30% year one, 30% year two, and then and 30% year three. So the IRS establishes depreciation tables and schedules per assets that you would be most likely to purchase in that particular type of business per what's called generally accepted accounting procedures. So all assets are going to go, physical assets are going to go to zero, and some things you can depreciate right off the bat, such as small tools. It's a physical piece of property, like this magnifying glass. Now this would be considered, it's a tool, it's an asset, but because it's small, it can probably be depreciated year one as just office supplies. And so you kind of need to know those kinds of things, and also know that, and this is one of the reasons why you as an entrepreneur want to hire an accountant or a bookkeeper, because they know how to do this. And as assets get expensed, now you don't have to pay income tax on it, because you're reducing the amount of asset value in the company and if you look down at the bottom there, as a depreciation expense. And it's important you understand that. And so the next thing it's important that you understand is that your income statement balances are all going to go to zero at the end of the year, and they're all going to go into an account called retained earnings, which is a subcategory of equity. So if, let's say you as a business owner invest money in your business from your personal account to the business, and you write a check out for, I don't know, $10,000 to your business, your Jones Enterprises, I'm just making a name up, that would go into, where you would show that transaction as a deposit to cash, and I think that has a credit or debit balance, I forget, but then the other place it goes is a double interest history. You'd show that it was an investment, and it would go, you'd have an equity account with your name on it, and that would show that you've put a personal investment into the company under your name under equity. So equity would show investments into the business, but we also would have an account under equity called retained earnings, and we use that to close out the income statement. It's such an integral part of the accounting equation that in QuickBooks, you can't delete it. It's an account you can't delete. That's how essential that account is in the whole accounting process. So if we take a look here, it's a blow up on that. Your revenue accounts, reversing journal entry, whatever the balance of your revenue accounts will have a reversing entry goes into revenue, direct cost of sales, and overhead to zero those out. So one second past midnight of your new fiscal year, all those accounts go to zero. And the second you deposit any money or write a check to a vendor, they start to go up again. This is another important, and I love this graph here in terms of market value, but the value of your assets, everything, the worth of your business in terms of if you went to auction, if you went to sell all the assets of your company, that would be based on, the fair market price that you can get someone to buy something for. So there's what we call market value versus our book value. So book value is all the value of cash plus all of our physical assets that have not been depreciated yet. And if we don't buy any assets and just have cash, eventually all those assets will go to zero and we're just sitting on cash. Cash does not depreciate, by the way. And again, all this is based on IRS rules and procedures. So market value versus book value, or book value versus market value. And market price versus demand, again, this is, our assets are going to be worth what the market demand is for them or what we can sell them for. So we have, market price, and this gets into the whole supply and demand thing, and I don't know how relevant that is right now in terms of our talk and understanding financial statements and doing cash flow projections, but just know that the assets of the business, again, the value is directly related to the market demand for those things. So if the assets we have, there's a high market demand, we will have a high market price that we can get value in terms of market value of these assets. Again, we're getting close to wrapping up, but I just want to again emphasize that I want to talk a little bit about business valuation. So sometimes it's buying a business versus building a business, because buying a business already has its customers, and if the business isn't named after the entrepreneur that's selling it, this might be a more wise decision to buy a pre-existing business that's already up and running. It's got its book, it's got its market share, it's got customer, and so there's a whole market out there of what's called business brokers, and these people have various different techniques, just like real estate brokers, to put a value, the worth of a business. It's usually based on the cash flow of the business times what's called a multiple. So 2 times the more established the business is in terms of goodwill and strength of cash flow, it can have a higher multiple number. So usually the value business is based on its cash flow times a multiple. And oddly enough, it has nothing to do with the asset value, the market value of the business. Sometimes that's dealt with from a negotiation standpoint, but generally speaking, the market value of a business, of what it would be sold for, is its revenue times a multiple of some sort. And there's books and journals, and the business broker has a lot to do with figuring out what those multiples are. Just a little insight into that. But anyway, the bottom line is the basic knowledge of the accounting equation is the key to unlocking the value of QuickBooks in terms of being able to know how to put information in and how to create reports and understand what the reports are doing. I highly recommend that one of the first things you do when you start a business is you start a relationship with an accountant. Whatever it cost, a few $100s, $1,000, but initiate a relationship with a CPA to file your tax returns. You do not want to do that stuff yourself, as well as is to work with a bookkeeper who costs a lot less than a CPA to go over your books and work with you in setting up your books. And often you can do the bookkeeping yourself, but then make sure a CPA is looking over your shoulder and helps you set up your general ledger chart of accounts, and that you know how to work with these. Because at the end of the year, boy, it is just so easy just to turn your computer files over to the CPA that has current credit card balances, checking account balances, and then there's your tax return. If you don't do this type of bookkeeping and accounting throughout the year, your first year could be in a really, really nasty situation with a deadline for a tax return, and you haven't been tracking any of this stuff. So when you go into business, know that, this is an important part of business hygiene, is keeping your books current. So every time you write a check, that needs to be entered into Quick and QuickBooks. Same thing with a credit card charge. If you don't do this, you're creating a monster of work that's got to be figured out at the end of the year. And if you haven't been saving receipts and transactions and bank statements and things like that, it could be the kiss of death. So understanding this stuff and getting involved with it at the very, very beginning of launching a business is just an essential aspect to avoid financial failure at the end of the year. Because if you have like 2 days before tax, returns are required, and you haven't been doing any bookkeeping or any accounting for the entire fiscal year, oh my gosh. So that you wind up filing extensions, but then based on the income, the money you've deposited in the bank, you still have to write an approximate check for the income tax based on that, because you're not able to take out, your expenses. So, you've got to be on the stuff. Make time on a weekly basis to keep your books current. And there's just a sense of being in control when your financials are current and all your transactions are entered in the computer. You just have a sense of being in control of your finances, and if you don't, you feel vulnerable. Anyway, know your business by the numbers, understand your accounting equation, and know how to forecast your financial statements, working with CPAs. And that concludes our introduction to the accounting equation and financial statements. We'll see you at our next lecture.